thank again very much Eduardo and Augusto in order to, because they really spend quite some time organizing everything. So that's wonderful that they do all of that for the group here. And today is extremely exciting because we have two very prestigious speakers. We're going to start with Riccardo Crescenzi from the London School of Economics. And you can see from the title that he's going to be telling us a little bit more about foreign investment in Africa. And then next, we're going to move on to Professor Dusan Paredes, who is working at the Catholic University of the North in Chile. And is going to focus on an issue which is dealing with crowding out and mining in Chile. So thank you so much to both of you for accepting to share some of your time with us. And then Riccardo, you can take it from there whenever you're ready.
I have 20 minutes.
Yeah, roughly. Don't worry. We are not going to stop you if you're in the middle of a sentence. So okay, Riccardo, it's all yours. I can hear you well and I can see you.
Okay, yes. Great, thank you. Thanks for the invite. It's really great to be with you all, although virtually, unfortunately. And today I will share with you some of ongoing research joint with Nicola Limodio at Bocconi University that is part of a wider research project that looks at the impact of foreign direct investments in Europe, in the United States, and then in the wider world. Funded by the European Research Council. So this particular paper looks at the impact of FDI in Ethiopia. And the specific focus of the paper is on Chinese FDI, so something that is particularly important at the moment where there is a lot of debate on the contribution of China to world development. And China is a very, very important investor in Africa. However, when looking at this contribution, so in terms of size, this is a hugely important contribution in terms of overall capital flowing to China. However, the big questions on what is the overall impact, what happens to the places, and we will look in this case at urban areas that are in receipt and non-urban areas that are in receipt of Chinese foreign direct investment. What is the impact of the presence of Chinese investment in Africa? And there is relatively limited research, mostly due to constraint in terms of data availability. And this has left a lot of room for ideological debate and also uninformed policymaking in terms of also supranational organizations, in terms of how to advise local governments in Africa, in terms of what type of investments to accept, what type of investment to facilitate, what type of investments to attract. There are different schools of thought. Like I said, mostly ideological when thinking about Chinese investments in Africa. Part of the story is, how Africa is becoming China's China, so a sort of a colony of China. On the one hand, this is seen as something that brings capital where it is needed the most. So it's something where China is driving global prosperity in a certain sense. So is allowing capital to flow where it is needed the most, where there is a lower capital labor ratio, so to say. So it is something that should be welcomed. Of course, others see this as a chain of colonialism, as something that brings about a very important legacy and comes with very significant constraints in terms of the use of the funds and in terms of what then Chinese funds do in their host economy. So, and in the media, you see a lot of these contending views. A contribution to development vis-a-vis something that comes as a huge burden because it comes with lots of strings attached. So it becomes really important to try and inform this debate with the data that are available and try to see, what is the role of Chinese investments in Africa? Do they really bring about development? Do they bring about growth or not? And under what conditions? So these are the fundamental questions, and these are the big, large debates this paper aims to contribute to. So this paper develops a new empirical test on the impact of foreign direct investments in using the case of Ethiopia. And I will discuss with you why the Ethiopian case is particularly interesting. It will leverage a unique firm-level database based on the census of large and medium Ethiopian firms over the 2002-2012 period. We use the universe of FDI projects geolocalized at the district level by relying on information from the Ethiopian Investment Commission. So all foreign direct investments need to be authorized in order to be made operational in the country. So this source also covers all possible investments arriving into Ethiopia with their characteristics. Then when looking at impacts, we look at the impacts on domestic firms by using our census at the firm level, but we also go beyond the firm level by looking at district level impacts. And to do this, we rely on satellite lights that give us information on economic activity with a very fine-grained spatial definition that we make comparable over time, so as to be able to capture the wider, more general regional effect of FDI. In order to identify impacts, of course, we cannot assume that investments are just randomly distributed over Ethiopian districts. So we need an exogenous source of variation that can explain investments from China into Ethiopia and their location at the district level without at the same time impacting the economic performance of firms and districts. And so we rely on an exogenous variation in Chinese FDI at the district sector level. And this exogenous source of variation comes from Chinese domestic industrial policy, whereby Chinese authorities are playing around with what I will discuss in a second are VAT rebates, so incentives for exporters to actually export. So their VAT system generates a sort of a tax on exports. And the intuition here is basically that firms, in order to avoid this tax and still sell on the global market, will, once there is a higher tax on their exports, will open a foreign subsidiaries in order to still be able to serve foreign markets without incurring in an export tax. So we will leverage this variation in VAT rates on exports, and we'll discuss how it works, as something that is done by the Chinese authorities mainly based on domestic market considerations, and we will leverage this as something that generates an exogenous variation in Chinese FDI. So these are the data sources that the paper uses, and this is the novelty in the empirical framework. So we use this variation in export taxes in China across sectors and over time as an exogenous source of variation. Then we use the variation across Ethiopian district in order to create a sectoral exposure. So it's a sort of like Bartik instrument. We have this variation across sectors and over time in China, and this gets associated to Ethiopian districts given their sectoral composition. It gives us a measure of exposure to the exogenous shock. And then we use the variation within districts and across sectors as our instrument for Chinese FDI eating each individual district. So this is the paper in a nutshell, the key findings. From the first stage, well, what we see is that when Chinese export taxes are going up in a certain sector, this, as expected, leads to an increase in FDI in that sector in Ethiopia. So the instrument works. It is stronger in cities more exposed to the treated sector. And it does not affect non-Chinese FDI in Ethiopia. So the instrument is really capturing this Chinese effect, not the overall external market conditions linked that would affect FDI coming to Ethiopia in general. So this is like how the first stage works. I will show you. Then in the second, in the second stage, what we do see is that Chinese FDI leads to heterogeneous effects. Firms in the same district sector as the Chinese investment shrink and divest. So we do identify a competition effect when it comes to new Chinese foreign firms becoming operational in the Ethiopian district sector. So firms in the same district sector as the Chinese investment and to shrink and divest, competition shock coming from the foreign firm becoming operational into the local economy. Firms in the same district, so that are located in the same district, but are in either upstream or downstream sector, so they buy inputs from the Chinese firm or they sell inputs to it, so that are upstream or downstream with reference to the foreign Chinese investor, then those firms expand. And we will see how they invest more, they expand their employment, et cetera, et cetera. So there is a beneficial effect along the supply chain. Other firms in the same district, so those that are neither downstream nor downstream, and they are not in the same sector, they are unaffected. So there is not like a wider spillover effect. Overall, there is an instantaneous effect on the district growth by measured by our satellite lines, that is 0. So basically, overall, the overall compositional regional level effect, when you take into account what is destroyed by the competition effect and what is created through the supply chain, then the overall sort of like general equilibrium, regional, local general equilibrium effect is 0. However, in the medium run, the positive effect on the suppliers tends to prevail over the competition effect on domestic competitors. And so in the medium-term effect, on district growth becomes turn positive over the period between 3 years after the investment and 12 years. So this is like a positive message saying these investments overall, if you take into account what is destroyed and what is created, overall, the effect is positive and significant and growing over time. I will skip on the literature. There is a wide literature that is combined in this analysis, the proximity concentration trade-off that explain the links between FDI and experts, that is behind the logic of our instrument. And then, of course, this paper speaks to the wider literature on FDI, local firms, and agglomeration economies. Knowledge spillovers, vertical knowledge spillovers, given that what we are dealing with are these effects that go through the supply chain, local industry agglomeration effects, the sort of like competition within the same agglomeration, within the same district. And then it also contributes and talks to a literature that has to do with FDI in Africa, relatively limited, and FDI in Ethiopia. And this literature has really been like mostly inconclusive, highlighting both positive and negative effects. And we feel that our analysis might also explain why. It very much depends on what is it that prevails, if it is the supply chain channel or the competition effect. So we feel that our results can also like shed new light on the existing literature that is mostly inconclusive on the impact of FDI in Ethiopia. So yeah, I have very limited time left. I will want to show you just the results. I gave you an idea of the paper. I can share the current draft of the paper if anyone is interested. So let me just like give you a flavor of the key results. Like I said, the overall like identification strategy is very straightforward. I want to give you an idea of the geography of FDI in Ethiopia. So this is Ethiopia. These are the districts we are dealing with. Overall districts that are in receipt of FDI in Ethiopia, and districts that are in receipt of Chinese FDI. The exogenous variation. So where does the exogenous variation come from? So just to give you the intuition, basically we have VAT on domestic sale. So when you sell something, you pay VAT on your sales. Of course, you pay VAT taking out on the value that you add, basically. So taking out the inputs that you have used to produce your final sales. When you export something, basically you have a sale tax that is a levy that is taken by other governments. So other foreign governments are taking are charging the VAT on what you sell abroad. So basically what happens is that your domestic government offers you a rebate, so discounts that VAT from what you have sold abroad. And globally, in order to make this system neutral, not to create a disincentive to export, basically what happens is that the rebate is set at the same level as what is done when you sell domestically, to make sure that basically you don't lose out when you export. What China is doing instead is not always, and not for all sectors, guaranteeing the same rebate as they do domestically. So when you export something, basically you don't get refunded for the full VAT you should be refunded for. So on this, we rely on a paper by Gourdon et al. That collected data on VAT rebates in China and exploit this non-neutrality of the Chinese value-added tax system. And China is changing the rebate across sectors quite frequently and with significant variations across sectors. So that is basically the variability that we exploit across sectors and over time. And this gives you an idea of how diversified this is over sectors. It is non-monotonous. Sometimes it goes up, sometimes it goes down. Some sectors are more stable, others have more jumps. So they proactively use this tool as a means to make sure that certain goods in certain sectors that are considered particularly important for the country are not exported, so that there is more to serve domestic demand. This gives you an idea of the overall variation across sectors. For some sectors, there is a lot of variability over time. For other sectors, there is less. Okay, here you have like an example of the industrial profile of different districts. So the districts that you have seen on the map. Different districts have different specialization profile. This is an example of Ajama, one of the districts that I showed you in the map, just to show you how diversified the profiles are and how specialized some of the districts are when it comes to their sectoral profile. So like I said, let me be quick on that. So first stage, Chinese export taxes predict Chinese FDI, first stage. Second stage, we look at the impact of Chinese FDI on aggregate outcomes at the district sector, firms outcomes for upstream and downstream sectors in districts, aggregate outcome at the district level. And then the wider like local economic effect using satellite lights. So like very briefly, like on this is like very straightforward, like the first stage, Chinese FDI in Ethiopia, the district sector 20 are explained, are predicted through the changes in the VAT rates times the exposure measure at the district sector level. And this gives you an idea of what is it that we get. So what we get is a very strong first stage that gives us like a very strong prediction of FDI inflows explained through our measure of exposure. If you look at value, if you look at the number of projects, if you look at the probability that 0-1 dummy getting an investment or not getting an investment. What we use is the log value as our main instrument. And then here we play around with different different fixed effects. I have 2 minutes. Let me jump into the second stage results. So the key result, like the second stage, is basically the Chinese FDI instrumented and a bunch of fixed effects. Outcomes are production, in this case, employment, investment, raw material, and a price and the price index to see, okay, what is going on, when the Chinese firm enters a particular sector and a particular district. So these are our results for Chinese FDI and the sector district aggregates. Our value of production, like we said, goes down in the sector, total employment, book machine values, raw materials. So negative effect, like we mentioned before, a strongly negative effect coming from the competition effect from Chinese FDI. Then what happens? Firm level analysis. So here the unit of observation are our firms. So we are zooming in so that we can identify upstream, downstream firms active in the same sector rather than aggregating. And again, here we can see when we look at firms that compete with our Chinese FDI, total value of production is going down, employment is going down, investments going down, similar effect on the price index. Again, a bunch of fixed effects, establishment, sector year, district year level, very strong first stage. Similar story. Here, let me jump into the upstream, downstream results. So here, what we do is to look at the effect on firms that are located in the same district, but upstream and downstream sectors, vis-a-vis the Chinese investment. We follow Antras et al., Antras and Schur, to identify what is upstream and what is downstream. Let me quickly jump onto the results. Here, we see that when we look at upstream firms, we see that the result turn positive. So we see that we have an expansion in the key measure of firm performance that we discussed before. This is true in particular for firms that are upstream vis-a-vis the Chinese firm. With downstream, the result is much weaker. So the strong, like, positive impact comes through the upstream firms that compensate for the competition effects. Overall, and then I'm concluding, overall regional level effects coming from the collection of satellite night lights. This is a picture of Ethiopia in 1993. This is what Ethiopia looked like in 2012 in terms of night lights. Our models. So again, when we work with the lights, we aggregate at the sectoral, at the district level. So this is a very simple, like, regional growth equation with a bunch of fixed effect and FDI and Chinese FDI as the key shock variable. So and what we get is that when we do see again a stronger first stage, and we do see that investments start playing a neutral role. So they seem not to have, like, an impact on overall growth, economic growth in the districts. So the competition effect and the supply chain effect seems to be getting to a precisely estimated zero. However, then if we, like, start looking into the medium run effect, then and we go and extend the time span, we start seeing that the effects, in particular with the IV, so if we take into account the fact that districts are shocked in a non-random way, we start seeing that a positive effect start emerging when we go after the third year towards the 12th year. So in an overall, like, positive effect starts to emerge, but it takes more time. It's more on the medium run. Then in the paper, you find a bunch of robustness checks. I'm not spending time here, but everything is in the paper. Just very briefly, we think this is like an understudied topic. Data are not perfect, but we think it's really worth trying, and it is a fascinating setting and a very fascinating country. And what I failed to mention is that we are really like capturing the stages at which the country was opening up to FDI. So when FDI in the country started really to go up, where globalization started becoming an important part of the developmental story of the country. So we also, in this respect, we think it's a relevant contribution. And we hope this can contribute to a more like evidence-based way of thinking about FDI. It's something that can tell a mixed picture. So there is not definitely one side to be taken in the existing literature on this particular topic. There are heterogeneous effects. But this is very important. It's very important to be highlighted because this has very important implications for public policies on how public policies should be targeted in order to reinforce the local environment at the same time as pushing for an opening up of local economies. If we are good in reinforcing the receptive environment, in creating a strong investment ecosystem in terms of domestic firms, then this might make it possible to compensate and to minimize the negative effects from FDI and maximize the positive returns from those investments. Thank you.
Okay, Riccardo, thank you so much. Very interesting work here. I have one suggestion and then one question for you. So my suggestion is on the way you identify those upstream and downstream industries. It wasn't fully clear to me how you do it. The way I would have eventually approached it is by looking at the national input-output table to at least get a rough idea. There may be a mismatch between the sectoral level you have and that actual national table, but you may still eventually justify, okay, so are the sectors upstream, so are the downstream based on the IO national. I can think about two possible sources, and if you struggle with it, I can send them to you, it's not a problem. The first one is EORA, the EORA data set. There is indeed a national level table for Ethiopia. And the second one could eventually be from IFPRI. IFPRI has more focus on agricultural commodities, but there is still manufacturing and services into it. So again, if you struggle with it, I can send it to you. Now, let me come to my question, which is a little bit more serious. Obviously, your focus is completely on China, it's fine, but I'm wondering if, to some extent, even in your first stage, that change in a rate coming from China, you obviously focus it on FDI from China. But at the same time, it seems to me that non-Chinese and foreign companies may also be interested in that variation. So for instance, the Chinese change their rate, suddenly an American company may see it as an opportunity to have more FDI eventually in a country. And to some extent, even in your second stage, that marginal effect that you are capturing, I find that they may actually not necessarily include what's happening with respect to foreign companies which are not Chinese. So is it something you think is worth looking into, or is it just one more robustness check? What do you think?
Oh, well, so thanks for your first comment on the input output. We also, I think it's part of the robustness checks. We also try and play around with the Ethiopian national input output table. Here we try to link with Antra's work to try to get something that is like more general on this upstream and downstream type of effects. But we also we get very similar results given how aggregate this is in the end in terms of the sectoral like definition that you have for firms and FDI. We get something that is comparable. But it's definitely like worth mentioning this. On non-Chinese FDI, well, on the one hand, in terms of identification, you really don't want other FDI to be affected by the Chinese shock in a certain sense. So you want to that to be directly linked with Chinese FDI and not impact the outcomes through other channels, including like other FDI. We do have data on all FDI entering the country. So what we checked is that the first stage basically doesn't work also for like the old set of FDI, and we play with different time lags. So we also try to see, okay, but is there an effect on other FDI at different like moments in time? So we do a sort of lead and lag analysis also to see if this effect, if changes in global FDI flows either anticipate or are anticipated by Chinese policy changes, and this is not the case. However, it is definitely like worth probably playing around more with total FDI as well. Also because this allows us to enrich the story. We feel the focus on Chinese FDI is particularly important because of the role that they play at the moment in China, that they play in Africa. So the relevance of the focus on Chinese FDI seems, and the specificities of these investments seems to justify the focus of the analysis.
Okay, yeah, that's a good point, Riccardo. I think my question was driven by that bullet point where you mentioned that so Chinese FDI are roughly 10% of the total FDI. So I thought, you know, eventually, so the remaining 90% may also be at stake. So eventually, make it super clear at some point so that, you know, you don't.
No, exactly. That's a good.
Perfect. Yeah. Okay, let's collect additional comments and questions for Riccardo. If you have any, just unmute yourself, please.
So hi Riccardo, Stefan is speaking, Stefan Poski. So actually I have two questions, actually a little bit smaller questions, but just out of interest. So the first thing is, have you ever tried out to see if the export rebates affect exports? So have you ever regressed the exports on the export rebates in China, just to see if you're, in some way what I would expect is that the rebates, so if your whole story works that way, that a firm in some way make this trade-off decision, should I export or should I make an FDI, then you would expect that the export rebate affects negatively the exports.
Yeah, that's basically the paper where the data from the rebates come from was looking at exports.
Oh, okay.
So their old paper is looking at the link between these rebates and that are mostly focused on internal issues, how and to what extent they impact trade in general. Although what we did is also check that this is true for Ethiopia in particular.
Okay, and so the second question is actually more: have you ever tried to look at sectoral differences? So some way I know this. No, also more like black populistic idea is that no, China is coming into Africa, doing all the resource, the FDIs into natural resources, and no, a little bit like the locust story. So they come in, destroy everything, and go out again. So have you ever tried to look at different sectors, how if the impact of these sectors are differently? I don't know if you can do it if you have enough observations. Huh?
No, we need to check. I'm not sure. You see to actually unpack the sectoral heterogeneity and see if in certain sectors you have, because the intrasectoral, so what happens in the same sector as the investment, the impact is negative. But you say, okay, can you unpack it and explore this heterogeneity a bit better to see if. Okay, yeah, I see. Yeah, that's a good point. Yeah, we can do that.
Do you have any sectoral fixed effect, Riccardo, in either stage 1 or 2?
Yeah.
Okay, yes. So you could eventually recover those marginal effects.
Exactly. And tell a story, like a nuanced story on the yeah, absolutely. Yes.
Very good. More comments, questions for Riccardo? Okay, if not, then thank you so much, Riccardo, for your time. Thank you, very interesting. And we are going to move from the United Kingdom to Chile with Professor Dusan Paredes, who is going to focus, as you can see from his slide here, on crowding out and mining in Chile. Thank you so much, Dusan. Whenever you're ready, it's all yours.
Okay. Well, first of all, thank you so much for this invitation. And actually, it's a pleasure for me returning to Real. I spent a lot of time there, so I'm certainly happy about that. So today, I will talk about this paper. The idea of this paper is to analyze the crowding out in mining localities in Chile. My co-author is Mauricio Yarzo, who is another Chilean colleague. And I want to explain the idea of the paper before starting the discussion. Okay, so here the idea is every time that you have local governments, sometimes you are receiving free money. Okay, that could be a donation, that could be a charity, or sometimes that could be a windfall. Okay, mainly coming from the mining companies. Okay, so of course, when you are a local government, you want to maximize the provision of local public goods under the assumption that using this channel, you will increase the welfare of the local people who are living there. But now, when you see the structure of the income in local government, you realize that all of them have a very high political cost. So for example, if you want to get more money from property taxes, you are really putting in risk the probability of getting elected in the next period, for example. Okay, so from this perspective, if you're receiving free money, so the question is, will you make the same effort for collecting these alternative sources or not? Okay. Of course, if you are very benevolent and if you are really doing a good job, then the local policymaker, they will keep the effort in alternative income sources. But if you think from in a strategic behavior, so maybe if you're receiving one extra dollar, free extra dollar, so maybe you will say, well, maybe I don't have too much incentive to push the payment taxes, okay? Because I already have this extra dollar. So that's the reason why with Mauricio, we are trying to analyze this question in Chile, but in this paper, we are putting attention in a second branch of the problem. Because in Chile, and that is different than US, almost the 70% of the municipalities, they don't have the tax base for collecting local taxes, okay? So that means that the taxable value of properties is extremely low. So in another 30%, they are really collecting property taxes. So we call this group, we'll call it high responsibility in the provision of public goods, okay? And we call it high responsibility because they really can make this substitution between free money and property tax, okay? And that is the idea of the paper, and I can tell you the result. The result is that we find some evidence about crowding effect, particularly for the group of high responsibility, okay? I don't know how familiar you are with Chile. Here I put some pictures. Maybe you are very familiar because the wine, okay? Because we have a very good wine in the industry, but we are also one of the main copper producers in the world, okay? So that means that the mining companies, they play a very important role, not only in the national budget, okay? But also in the local budget. And the main channel between the mining companies and the local governments come from the mining windfalls, okay? The mining windfalls are, in some sense, they are like royalties, but they are not technically royalty, but that is a compensation payment that the mining companies make in order to counteract the negative externalities coming from the mining production. So the structure of this paper, well, introduction, I will go very fast to the data, the methodology, results, and conclusion. So first, as I told you, the Chilean mining municipalities, but not only in Chile, I would assume that in the most of the mining countries, the local communities, the local mining communities, they receive windfalls, free windfalls generally, okay? You don't have to make any effort for collecting because that is just given in order to make a compensation, okay? However, we don't know at the subnational level what kind of behavior, strategic behavior is generating these kinds of free lunch in some sense. And also, of course, in the case of Latin American countries, we really need to put attention on the different level of responsibility that we have in the municipalities, okay? Maybe this idea doesn't make sense for all of you, but in Chile, we have a very centralized system. So that means that more than the 90 or maybe even the 100% of the public budget in the local community is coming from the central government. So of course, in this case, we are not expecting any crowding out because they can't manage this effort. But we are putting the attention on this small portion of municipalities who really can make this exercise, okay? The higher responsibility municipalities, that is a label that we apply for this group. So this is Chile. Well, as you know, Chile has a very particular geographical shape. So that means that we can't plot the complete map generally. But here we have Chile is broken in 3 parts. And just let me see if I can do that. Okay, so this is the north part of the country. We are here very close to Peru and Bolivia. I am here right now in this point. And of course, here are the mining companies. The mining companies are located in this area. And that is the reason why here we have the highest level of mining windfalls, okay? So just keeping in mind that the mining windfall in some communities even could be more than the 40% of the total local budget, okay? So it's a lot of money, actually. If we see the situation between 2008 and 2019 doesn't change that much. We also have some different kind of mining companies in the rest of the countries. Not all of them are belong to the copper area, but at the end of the day, they also pay some windfalls to the local communities. So now, if we want to see the dynamic of this process, when I'm saying dynamic, I'm saying how many communities received a windfall in 2008 and how many of them are still receiving in 2019, okay? So actually this transition is very low. Here, all the white areas are all those areas who never changed the condition between 2008 and 2019. So you can see that more than the 80% of the counties, they never changed the condition of mining, okay? And that is important in the empirical side, okay? I will come back to this point later. So the idea of this working paper is pretty simple. I mean, we only want to analyze if so here I think that question 1 is much clearer. So the idea here is, if I receive a mining windfall yesterday, is this mining windfall that is free is affecting my tax effort collection today, okay? And that's the reason why maybe we're expecting a negative sign between these 2 variables under the assumption that we really don't want to make a lot of effort. I mean, if I have a free money from yesterday, maybe I will use the free money for making a substitution between all those incomes who has a very high political cost, okay? So for example, if you're a mayor in a city, you don't want to increase the taxes because you know that maybe will affect your probability of getting elected in the future. The data that we have, so now just the first, I will divide the country according to 2 groups, okay? The first one is mining and no mining, okay? And the second one is high responsibility and lower responsibility, okay? So for example, if we take all together, we'll realize that the property tax, so just in parentheses, we are using the property tax as a proxy of tax collection effort because it's the most important variable who is increasing the local budget, okay? And that's the reason why, and even when Chile is a very centralized system, the local communities, they still have some tools for really affecting the property tax collection. So as you can see here, the average collection in the non-mining areas is much higher than in mining areas. So in some sense, the taxable value of properties in non-mining is much more higher, it's almost 2.5 times than in the mining regions. But now, if we split this group between high responsibility and low responsibility, we have a new scenario. Here, you can see that in the case of non-mining, they are collecting 7.2 million in average dollars, but the lower responsibility, they are only collecting just 0.1. So that's the reason why we are saying that we need to put attention on the level of responsibility that this community they have. Here we have the same dependent variable, the property tax, but now across the time, just for providing you enough evidence to support the role of property taxes, okay? So now we have the dependent variable. So remember, the dependent variable is the property taxes. And of course, the main control variable, the main one, will be the mining windfalls, okay? So in the case of non-mining, well, we don't have mining windfalls. But in the case of mining, this is a positive magnitude. But of course, the property tax collection is not just affected by the mining windfalls. It's affecting for different variables too. So here I will divide this control variable in 4 groups. The first one, we'll call it financial variables. Of course, if you have better financial conditions, you will get more property taxes. The second one, we call it economies of scales. The third one, we call it professionalization of the municipality. Of course, if you have a huge team of management people working there, maybe you can make a higher effort collection. And also, we are adding some political conditions. So in this case, the coalition means that if you have a match between the political party of the mayor with the national government, if there is a match, we are expecting maybe a better financial conditions. And in the case of Chile, the distancia to Santiago could be also a political variable, because if you are closer to Santiago, given the extreme centralization that we have in the country, maybe you have more political favoritism in some political decisions too. The methodology, well, so let me explain this idea. The question 2 is, here we have the property tax collection in the period T, and the key parameter is the beta 1. And we're expecting beta 1 to be negative. So that means that if you receive $1 extra yesterday, free extra dollar from mining windfalls, we're expecting that in the future, you are reducing your effort for property taxes, okay? So now, given the institutional design of Chile, even if you are no mining, you can receive some money from tax windfalls, okay? And that's the reason why we add an interaction variable equal to 0 if you are no mining, and equal to 1. It's just in order to make interaction. So the question 2 is pretty easy to understand, but the problem that we have is that we are not controlling for the responsibility level, okay, that I told you before. So in the question 3, it's exactly the same setup, it's exactly the same idea. The only thing that we are adding here is the control variable between the high responsibility and low responsibility, okay? The problem with equation 3, of course, is that the beta coefficient doesn't have a clear interpretation anymore. We have to work with margin, okay? Because otherwise it will be impossible to recover the marginal effect. Also, of course, we have some control variables. Remember that we have 3 groups of control variables, and we have time effect and local fixed effects in the future. The problem with equation 2 and equation 3, maybe they are very clear, but we have a lot of evidence about that the main explanatory variable for the local budget today, or for the local property tax today, is the property tax of collection of yesterday, okay? So that's the reason why, after some time with my co-author, we decided to include the property tax in a lagged form too, okay? And of course, here we will have to work with a dynamic panel data. So the good news is that now we can split the effect in a short run and long run effect, okay? The bad news is now, of course, the explanation power of this variable is huge. So that is the reason why if we get some significant result after including this variable, we will be very happy too. So the results. So just let me explain the structure of the table, okay? So here we have the equation 2. That is a total equation, okay? In the equation 2, and we have 3 columns. The only difference between column 1, column 2, and column 3 is the group of controls, okay? The column 1 has just 1 group, the column 2, 1 and 2 groups, and the column 3 is 1, 2, and 3, okay? So let's go to put attention on the key marginal effect is a mining windfall, okay? So when we have the best specification, we are finding a negative sign. So that means that if you receive $1 extra today from the mining windfall, so maybe tomorrow you will make a lower effort in the property tax collection in 20 cents, okay? And we don't find the same marginal effect for the case of no mining, okay? So that is a good news. Here we are controlling for yearly phase effects. And of course, the problem that we have in this first approach is that we are not controlling for the level of responsibility. Here, in this table, we have exactly the same structure, column 1, column 2, and column 3, but now we are adding a new interaction. As you can see here, we are the provision responsibility. And remember that our hypothesis is that we should observe a crowding out only in those communities with a high responsibility, okay? And the reason is because they are the only set of municipalities who really can make this transaction between property taxes and mining windfalls. And now we are finding even a bigger crowding out. As you remember, in the previous one, they were 20%. Here we are almost in a 40%, okay? After that, we say, well, we have good news because we have a crowding out. We are finding the crowding out in the high responsibility, but of course we have a huge endogeneity problem, okay? And the endogeneity problem, I have 5 minutes, no, 2 minutes, sorry. We are not suspecting about endogeneity in the mining windfalls, okay? And maybe you will say, why? Well, because the mining windfalls, they don't answer to the effort of the local governments. That's coming from geological conditions. I mean, the copper is there. And that's the reason why we are supporting the exogeneity of the mining windfalls, okay? The endogeneity is coming from actually the property tax collection of today, of course, is affecting for the property tax collection of yesterday, okay? So here we are including in a dynamic way the dependent variable. And here now we can split, okay, the short run and the long run. So if you sum, for example, in this, if you add the short run and the long run, now even is bigger the crowding out. Now we are talking about a 65%, okay? So actually, using the 3 different specifications, I will make a summary. First, we are identifying crowding out. Second, this crowding out is bigger in the case of high responsibility communities. And the third, even we have a crowding out effect not only in the short run, we also have it in the long run. So what is the good news or the bad news about the result? Okay, so we think that is a bad news. Why? Well, it's very easy. The windfalls, the idea of the windfall is that you over-provide local public goods in order to compensate the negative externalities from the mining industry. But now we realize that the local communities, they are taking this money just for reducing the effort for collecting other sources, okay? So that is an institutional problem, actually, in our opinion, of course. Now, that's the reason why we say they are not very good news, okay? Because in Chile, the only political support for the mining windfall is, they say, I mean, the mining ministry, they say, well, there you have money, just spend in your community. But nobody is putting attention on the strategic behavior behind this institutional design. And of course, the future work that we are doing now is, of course, we are suspecting about spatial autocorrelation. Here, I just provide general plot of a Moran test, and of course we have a spatial autocorrelation problem. This Moran test, we run it on the predicted error term in the last estimation. So that are the new avenues that our research is taking. So thank you so much, and any comment and improvement on the paper will be appreciated.
All right, Dusan, thank you so much. Very interesting stuff. Yeah, I have 2 comments / questions. I kind of did not fully get how those mining windfall are even decided on the first place. Sorry, I missed that. I did not fully get if it's the company itself that really decides it, or is it coming from the government? In other words, tell us more about how really exogenous it is to those local taxes. If you could say a few more. And my second part is, so obviously your focus is on property taxes. I don't have a good sense of how property taxes are a large or small part of the overall taxes that a local community raises, because we can also think about taxes on sales, taxes on labor income. So I'm just curious as to whether there is any interest into eventually looking at that potential crowd out on other aspects. For instance, I had the feeling that in Chile, a lot of those miners actually are, coming to do the work, eventually don't even own a house there. They just live in some kind of dormitory and then go back to their family after some time. So maybe their focus or their impact on the property is not huge. Maybe on sales is larger. I'm not sure. But what of developing the idea to other type of taxes? What do you think?
Yeah. Okay, the first point, so trust is exogenous, okay? I think so. The reason is there is a law that is supporting the rule for these payments, okay? It's not a voluntary payment, okay? So the rule only say that you have to pay windfalls according to the size of the exploration or exploitation coming from the mining production, okay? So that means that at the end of the year, the company must pay to the government these mining windfalls, and the government will take it and will assign to the mining counties in the country according to one rule, okay? And this magnitude is only a function of the size, okay, of the exploration. So that's the reason why I'm supporting that is exogenous, okay? And that is it's not voluntary payment. I mean, that is not that the company head come to talk with the mayor and say, okay, that is the money. No, that is not the case. That there is an institutional design for that, okay? And about the property tax, well, the property tax should be around, but that depends, because in Chile, if you take the local budget, I know that maybe will be a little bit complex for you understanding because it's very different from US, but almost the 50% of the local budget is coming from the central government just for education and health. So the local government, they don't have any decision role in this money. So you only have the 50%. And from this 50%, the property tax is maybe the most important local income source, okay? In this 50%, I would say that more than the 30% is coming from the local property taxes, okay? So, of course, we have other sources where we could observe crowding out, and you are right. But in our opinion, we started with this one because we're assuming that if exists any effect, should be observed in the property taxes, okay? And finally, in your last point, I think that is the most interesting thing, because one of the ideas of the mining windfalls is that nobody wants to live in the mining regions, okay? For these amenities, pollution, and anything. So the spirit of the mining windfalls is providing money from the local government for improving the provision of local public goods, for attracting these workers, for keeping these people living here. But now, according to these results, doesn't have any effect. If you provide money, you are only helping to the local government to don't make a big effort for collecting other sources. So that's the reason why we are saying that, of course, we need a lot of research for supporting this point, but in our opinion, according to the conversation with Mauricio, the main problem with the Chilean design is you are not putting rules on the use of this money. Okay. So for example, in the OECD, if you receive windfall, you have to use a matched grant. So that means that I will give you the windfalls, but first, you as a local government, you have to, if I put $1, you will have to pay another $1 too. And they are tied. Okay, maybe this institutional design could help. Okay, but you're right. The role of the long distance commuter is very important.
No, I think you have a very interesting outcome here, because it ended up making those communities completely dependent on those mining activities. And I'm guessing if at some point there is nothing to mine anymore, they simply go, and then the community has very little institutional background left to work with. So very good. Let's collect more comments and questions for Dusan, please.
Hi, Dusan. Stefan speaking. Actually, I have a question about your property tax. So first of all, very nice paper and very nice idea. I like this political game in some way, the strategic thing between the mining companies and the politics there. I didn't get really. So how do you calculate this local property tax? So if it is just like, if it's just the amount of local property tax collected each year, then it's just a measure how much property you have in a community in a given year. Huh?
Yeah.
And what you have said before, answering Sandy's comment, was that it could be that if you have huge mining operations going on, that just people move out because it's just very dirty and you have a lot of pollution. So people move away from the community, which would result in lower property tax incomes in the next year because nobody's living there anymore. Then could it be that your negative effect just measures the out-migration of the people and not the change in the tax efforts of the government? Do you know what I mean?
Yeah. No, I understand. The first question is a total property tax collected 1 year. Okay, it's a total property tax collected. And the second question, well, that is an alternative source. We control it in different specification. We control it by the size of population and sometimes with the long distance commuters. And I will say that the results are in the same line actually. Okay, I mean, in my opinion, when you have a dynamic panel data, or something is still significant after that, that means that maybe there is something that you really have there actually. Because generally the dynamic panel data is just absorbing everything, all the causal effects. So I agree with you, maybe that could be effective, but in our opinion, even controlling for that, because we have made the negative coefficient is still there. Okay. It's still there, and I'm very worried because it's around a 50%. Okay.
Yeah, and so, maybe you can just do it like a very short robustness exercise. Just look at the correlation between size of windfalls and the amount of houses. I know how property taxes can be measured there. To get some way a measure is how much are they related with each other. Yeah, and if you see that there is no strong thing going on, then you could be assured, more or less.
Yes. Thank you.
Thank you very much for the presentation.
Any chance to get data on out-migration at that spatial unit level? Does that exist in Chile, Dusan?
Latin America.
No, I know. I get it.
I mean, we have some sources, and we can include this idea, but generally the result they won't change, because in the first beginning, even I remember when we were talking with Mauricio, of course the corruption is always flying in your mind as a hypothesis. You always say, well, where is the money? I mean, where is this money? Because they are receiving the money actually. But after controlling and remember that we have a municipality fixed effect. Okay, so that means that if something is happening inside the municipality, and if that is time invariant, should be captured too. So, I mean, if I will have the migration outflows or community, great, I will include it automatically. We don't have it actually to this community, but even adding these controls a higher spatial scales, let's go to say that my scale is county, okay? But I have data for migration at a state level. And when I do that, the results are still the same, actually. And of course, when we say that to the local policymakers, they don't like a lot. I mean, they don't believe it, actually. They don't believe it.
Of course. Yeah, sure. Okay, Dusan, thank you so much. Riccardo, thank you so much to both of you. Grazie mille, muchísimas gracias.
Thank you, thank you.
Presentation. And I see all of you next week at the same time and same location. Thank you so much.
Thank you, guys. Bye.
Thanks, bye-bye.
Bye, Riccardo.
Ciao, bye-bye.